Okay. Employee benefits are all forms of consideration or payments given or promised to an employee in the process of giving service. Like our good friend Florence has told us that tomorrow evening he will be still in the office. Therefore, it means you are giving service. And at the end of the month, like now it's end month, I know you are smiling. Therefore, you are compensated. Those compensations is what we are saying employee benefits. Employee benefits includes things like salaries, wages, and my good friend Florence will tell me the difference between salaries and wages. Then we have bonuses, bonuses. We have profit sharing with the company. Sometimes good companies share profits. Then we have pension. Maybe you are getting pension from your employer. Employer is contributing pension for you. You are benefiting future. Therefore, these are what we are saying. Question, overtime. Thank you very much. You are saying overtime. Overtime is also a benefit, overtime. We have airtime. Sometimes you are getting airtime. It is very important to mention that. It's also a benefit. Any benefit you are getting from the employer, those are what we are saying employee benefits. Now, according to IAS 19, they put into these benefits into 4 categories. Types of benefits that IAS gives us, types of benefits based on IAS 19. We have 4 types of benefits that we need to look at. We have number 1, what we call short-term benefits. Number 2, we have what we call long-term benefits. Then number 3, we have what we call termination benefits. Number 4, we have what we call post-employment benefits, post-employment benefits. Those are the 4 categories or 4 types of benefits that are available according to IAS 19. Remember, we have a lot of benefits that are available to an employee. Like in the last lesson, we did IFRS to share-based payment. Share-based payment is also a benefit to an employee. Employee is benefiting by getting shares, but remember the scope of equity compensation is under IFRS 2. The scope is not in IAS 19. Therefore, IAS 19 gives us these categories of benefits or types of benefits. When we talk of short-term benefits, these are benefits that fall due within 12 months after giving service. These are benefits that fall due within 12 months. Within 12 months after giving service. Within 12 months. It will not go beyond 12 months. It's a short term. Example of this is salaries. Salaries, what we have mentioned, wages, anything that you are getting within a period of 12 months after providing service, that is what we call short-term benefits. Now, how do the employer account for this short-term benefit is now our interest. The interest in this scope is how the employer accounts for them these benefits. If it is short-term benefits, how do the employer recognizes these short-term benefits? Now, if the employer wants to recognize this, remember, salaries are expenses to the company. Salaries, wages, to allowances also fall as benefits. Yes, it's an allowance, it's a benefit. It's under salaries. Remember, allowance is within 12 months, it's under salaries, therefore it's a benefit. Then what we are saying is we are interested much in the accounting part of this, these short-term benefits, the accounting part. Therefore, how do the employer account for this? Remember, this is an expense to the company. Therefore, the employer will have to debit P&L with those amount is paying, then you credit cash. That is the accounting part. You charge it to P&L as an expense. As an expense, night out, those are the allowances, thank you very much. But they are falling due under short-term benefits. All those are allowances that you are mentioning there. They fall due, that is Waziri, thank you very much. They fall due within 12 months, therefore they are under short-term. Examples, salaries, wages, allowances, like what you are saying there, house allowances under salaries. Therefore, the interest here is how do we account for it? The employer will have to charge it to P&L. The employer will have to take it to P&L as an expense, then you credit cash. Then we come to long-term benefits. Long-term benefits, these are benefits that accrue to an employee 12 months after giving service. These are benefits that accrue to an employee in a period of 12 months after giving service. After giving service. Like example of this is long service pay, long service pay, long service pay, long service pay. We have what we call jubilee benefits. Jubilee benefits. Jubilee benefits. We have what we call sabbatical leave. Sabbatical leave, sabbatical leave. These are benefits that will accrue, like, for example, a period of 2 years, 3 years, 4 years, 5 years going forward. It's above 1 year, above 12 months. Therefore, example is long service pay. We have gratuity. Gratuity will also fall under long service, under long-term benefits. Now, well, some companies have policies, like for example, if you serve them for 5 years, they will give you a token. They give you something in form of a token. If you serve them for a period of 5 years, or 10 years, or 15 years, or 20 years, they give you what we call 5 years award, 10 years award, 15 years award, or 20 years award. They give very good tokens so that they can motivate you to provide more service to them. Therefore, example, if examiner asks you, giving examples, explain the meaning of long-term service, long-term benefits. Example is long service pay, jubilee benefits. Sabbatical leave is a leave you take, for example, for you want to go for study or medication, but the employer will still pay you. Some people, maybe you have health complications, you need to go to seek medication, maybe abroad or wherever. Therefore, you will have to take a leave of more than 1 year. But remember, the employer is still compensating you. Therefore, it is also under long service pay. Then we come to termination benefits. Termination benefits, these are benefits that an employee will get after the company has terminated the contract before. Which one is jubilee benefit? Jubilee benefit means, for example, we are celebrating something. We are celebrating like 10 years, 50 years, then we give you some tokens. How do you account the long-term? Long-term benefits, these are amortized over the period concerned. They are amortized over the period concerned. They are amortized. Like, for example, the employer knows very well that he's going to give you 2 million in the next 5 years. He's going to pay employees 2 million in the next 5 years. Now, what you do, you will take 2 million and divide by 5. Therefore, you are getting something like 100. Is it 100,000 or 200,000? 400,000. You are getting 400,000. Therefore, each year, the employer is recognizing 400,000 as an expense. Then the liability is also accruing the same way we were doing share-based payment. If you remember share-based payment, We were accruing the liability. At the same time, we were recognizing the expense. Therefore, we are going to amortize the same way we were doing share-based to recognize the expense and the liability, because we know in the next 5 years, you are going to pay 2 million. Therefore, you don't wait for the 5 years so that you recognize 2 million in your financial statement. That will be will distort your financial statement, because remember, you are just putting at once. Therefore, the profit at that year, it will be very minimal. The profit will be very minimal. Therefore, let me just mute you all. I can see background noise. Okay, therefore, we are going to amortize it over the period concerned to recognize a liability and to recognize the expense there. Then we come to termination. I was saying, this is where the employer might terminate your contract before normal retirement. Normal retirement, maybe the company is not doing well, therefore they will want to lay off some employees. Now, in the process, these employees need to be compensated. That compensation is what we call termination benefits. Or sometimes the employee may be interested in terminating that contract. For example, the employer is willing to pay those who terminate their contract. Therefore, you will voluntarily terminate that contract for the benefit to be paid, because you know that you are going to do much more with the money. Therefore, that is post-employment, that is termination. Now, termination can either be short-term, accounted as short-term, or long-term. Let me explain. When we talk of termination, termination can be accounted either as short-term or long-term. How will it be possible? For example, I'm terminating your contract, then you are required to be paid 10 million. Then I'm paying you 10 million in cash. The moment I terminate your contract, I give you 10 million. Therefore, I'm going to debit P&L. I credit cash just as short-term benefits. But sometimes you find that I need to give you 10 million, but we agree that I'm not giving you 10 million at once. So I will be paying you, maybe each year I pay you 1 million. Each year I pay you 1 million. Therefore, it means I'm going to account for it as long-term. As long-term, which means I'm going to amortize it over that period. Therefore, termination can either be, because it's all in all payments made. Therefore, I can debit P&L, credit cash if I'm paying it at once, or if I'm scattering payment, then I will do the amortization over the period concerned. That is termination benefit. Then we come to post-employment benefit. Post-employment benefit, these are benefits that will that an employee will get after normal retirement date. The benefits an employee will get after normal retirement. After normal retirement, you are expecting some benefits. Like, for example, you are working today. I know at some point you will have to retire, either by age or either other circumstances will cause you to retire from that employment. Therefore, at that time, you are required to be compensated there. Those are the 4 categories of benefits. Now, because post-employment is a very long-term benefit, we need to discuss it very much in detail, and that is where the examiner is interested. Under post-employment, this is where the examiner is interested much. Therefore, let's see how we are going to account for post-employment. That is where the examiner will be very much interested. Post-employment, how to account for pensions. How to account for pensions. Stay with us carefully, how to account for pension. Now, for the employer to pay pension, the employer needs to enter into what we call a pension scheme or a pension plan, because this is something you are going to pay for a very long period of time. Like, let me assume my good friend Waziri started employment at 20 years. When you are 20 years is when you are beginning this employment. You will retire in when you are 60. Therefore, you are going to work for 40 years. For 40 years. Therefore, you started employment maybe in 2020. You will retire in 2060. Therefore, this is a very long period of time. This is a very long period of time. As you can see, 40 years is not a joke. And in these 40 years, somebody is promising to pay you. Somebody is promising to pay you. Therefore, listen very carefully. Somebody is promising to pay you after 40 years. Therefore, here, what we do, the employer will enter into what we call a pension scheme. Into what we call a pension scheme. Now, how do pension scheme works? Therefore, here, we have here the employer. We have here the employer. Then we have the scheme. Then we have the employee. We have the employee. Therefore, each year, the employer will be contributing money to the scheme for your benefit post-employment. Then when the employee retires, the employee will not come to the employer for the benefits. The employee will go to the scheme to get the benefit. Therefore, it is the scheme that will compensate the employee, not the employer. It is the scheme, but the person that is funding the scheme is the employer. Is the employer that is contributing money to the scheme so that this scheme accumulates money and now pays out. Now, how is the scheme formed? How is the scheme formed? Listen very carefully, I tell you how is the scheme formed. In the scheme, we have what we call custodian. We have what we call custodian. Custodian is a bank. Any bank like KCB, like cooperative, like community bank, any bank can be a custodian. Now they work for a bank. The employee, when he takes the money, pension money, he don't take it to anybody. He takes it to the bank. This is a bank. You contribute money to, you take it to the bank directly. Then in the scheme also we have what we call a fund manager. Fund manager. Fund manager. We have what we call fund manager. This is an investment group. Investment group. Like when we go to the market, we have investment groups like CIC investment group, like Old Mutual investment group, Saiton investment group, Pan-African investment group. Therefore, when the employer takes money to the bank, we have somebody who is managing this money for investment purpose. Therefore, is a fund manager. He takes this money and invests in the market. You invest like in real estate. In real estate, you go to real estate. You got to invest in government bonds, government securities like bonds, government bonds. I believe you have ever had it. We invest in equity shares, Like you buy shares of Safaricom, you invest there. Therefore, you are going to invest the fund manager. Then in the scheme also we have what we call an administrator. Now the administrator will make sure that the employer is deducting money, is contributing money to the custodian, taking money to the bank, and this bank is giving the fund manager money to invest. And this fund manager also is investing based on RPA rules. Remember, this fund manager does not just invest, he will invest this money based on RPA rules. RPA means Retirement Benefits Authority rules. Therefore, RPA has given guidelines. When you want to invest money for pension, you don't just invest in one basket. You don't just invest anyhow. RPA has given rules on how to invest this money. Therefore, the administrator will make sure that the fund manager is investing money as required. Then in the scheme also, we have a person called actuary. Actuary or auditor. Actuary or auditor. Actuary or auditor. Now, auditor will make sure that the assets in the scheme are kept very well. You don't misuse the assets of the scheme. For example, if you are the fund manager, you are the custodian, you are not misusing the assets of the scheme. Therefore, when we talk of the scheme, these are the people that will make up the scheme. And these people are just chosen by the employer. For example, you have a company. Let me assume my good friend Daniel, you have a company. Then you want to provide pension to your employees. Therefore, you will look for this scheme. You will have to look for a bank. You look for a fund manager. You look for an administrator, then an actuary or an auditor, depending on the type of what? The scheme. I believe you understand when we say the scheme, you can now see it. You can see the scheme when we talk of the scheme under post-employment benefits. Therefore, the employer will not pay the beneficiary. It is the scheme that will have to pay the employees, the scheme that will pay the employees. Now, there are two types of this pension scheme. There are two types of 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 pension scheme. Number one, this scheme is what we are talking about. Number one, we have what we call defined contribution. We call it DC scheme. DC, defined contribution scheme. Then number two, we have what we call defined benefit. Defined benefit scheme. We call it DB. DB scheme, defined benefit and defined contribution scheme. I believe you understand when I say the scheme because I have explained in detail there. When I say the scheme, my good friend Edwin will be understanding what is the scheme. Now, when we talk of defined contribution scheme, this is what it means. This is what it means. Defined contribution means the amount the employer contributes to the scheme is fixed, is known. The amount you contribute, like for example, I can decide that I'm contributing 6% of the gross salary of the employees, 6% of the gross salary. Therefore, if you are earning 100,000, each year, the employer is deducting 6%, taking 6%, which means is taking 6,000 every month, 6,000. Therefore, every year, you are taking there 72,000 every year. You just know that 72,000 is going to the scheme for my benefit. If it is a DC scheme, then whatever the employer is contributing to the scheme is fixed. The 1 year is fixed. But what the employee, this person, you say me, what you will get when you retire is not known, is not fixed, is not fixed. The benefits will depend with the performance of this scheme, because we said in the scheme we have a manager investing this money in real estate, in government bonds, in equity. Therefore, whatever you will get when you retire as an employee, it will depend with the performance of the scheme. If the scheme performs very well, then you will have to afford high benefits. If the scheme performs poorly, then you will get very little. For example, you have contributed 72,000. Now you expect that at the end of the year when you are retiring, you are going to get 72,000. When you go to the scheme, you find that your money is even 100,000. Why? Because this money was invested and it brought some returns. It grew by the returns. Therefore, this scheme means whatever the employer contributed to the scheme is fixed, but what the employee will get is not fixed. Now, under DC, under defined contribution scheme, the risk, listen very carefully, the risk and the liability lies on the employee. The risk and liability lies on employee. Why? Because if the scheme performs very well, you will get high benefits. If the scheme performs very poorly, then you will get nothing. You will get very little. Therefore, the risk and liability lies on the employee. That is defined contribution. Let's go to defined benefit scheme. What does it mean? Under defined benefit, what the employer takes to the scheme is not fixed. What the employer takes to the scheme for the benefit of the employees is not fixed. But what the employee will get is predetermined, is fixed, is known in advance, is determined in advance. Like, for example, when you get your employment, you will retire in 2060. The employer, according to the formula we have, the formula, it costs 160 times, we have some variables that they use to calculate, putting in your salary, putting in your number of years that you work in the company. Therefore, we use this formula. Then we find that in 2060 or after 40 years, you are required to get 10 million. Therefore, what you will get, you just work and know that I will get 10 million. But whatever the employer is taking to the scheme is not fixed, is not fixed. Florence, you want to ask something. What do you want to ask? Let me unmute you. Let me look for Florence. Can you unmute yourself now?
Mwalimu, thank you. I have a question.
Yes.
Under the two types of pension scheme, there is this one for DC and DB. So I'm confused.
Yes.
You on your previous explanation, you said the scheme is the one compensating the employee.
Yes.
Under the definition that you're giving me under DC is that the employer is contributing a fixed amount.
Yes.
Hence, the employee will collect a fixed amount. Under DB, you are telling me that
what I'm saying, Florence,
yes,
is that what you are contributing to the scheme is fixed. For example, I said you are contributing 6% of your gross salary, that is 6,000 every month. But what you will get is not fixed, not fixed. It will depend with the performance of the scheme. I gave an example here. For example, you have contributed 72,000. When you go to the scheme, you find that your benefits are 100,000 because it has increased because of the performance has been good. But when we talk of defined benefit, what the employer is taking to the scheme is not fixed. But what the employee will get, I was saying it is fixed. Like, for example, you just know that when I retire, I will get 10 million. When you retire in 2060, for example, you will get 10 million. But what the employer is doing with the scheme, contributing to the scheme, in fact, it's none of your business. Yours, you just know that I'm working, but at the end of my retirement, I will get 10 million. Then what you will get is predetermined, is known in advance. But what the employer takes to the scheme is not fixed, is not fixed. That's what I'm saying, Florence. Is it clear, or you still have a question, Florence? Thank you very much. Thank you very much. Now, under defined benefit, listen very, very carefully. Under defined benefit, the risk and the liability lies on the employer. Under defined benefit, the risk and the liability lies on the employer. Why? Because employer is taking money to the scheme for the benefit of employees. Therefore, whatever the scheme is doing is a concern of the employer. If the scheme performs very well, remember the employer will pay you 10 million. Therefore, if the scheme performs very well, listen very carefully, if the scheme performs very well, then the employer will contribute very minimum amount, very little. But if the scheme does very poorly, then it means that the employer will go back to the pocket and contribute more amount and give more. If the scheme is doing poorly, the employer will have to go back to the pocket and give a lot of money for the benefit of the employee. Because anything, if the scheme performs very well, the employer will benefit. It means the employer will reduce on the contribution. For example, I remember I need to contribute up to 10 million, but the scheme is helping me. If the scheme, the investment does very well, then it means it is helping me to contribute so that the scheme, the money, the assets are growing. But if the scheme is not doing very well, it means it's my liability to make sure that the employee will get 10 million. Therefore, the risk and the liability lies on the employer. But when we go to a fixed defined contribution, this scheme, whatever the employer is contributing is just not like 6%. You just know that at the end of the month, 6% of my salary is going to the scheme. But whatever you will get, it will depend with the performance of the scheme. If the scheme does very well, the benefit will go to the employee here. The benefits will go to the employee there. If the scheme does very well. Therefore, that is the two types of pension schemes that we have available, this DC scheme and the DB scheme. Now, let me ask my good friend Edwin, which one is the best for you, Edwin? I have unmuted you. Which one is the best scheme for you, Edwin? Talk to me.
As an employer or as an employee?
As an employee, which one is the best for you? Do you go for the DC scheme or DB scheme?
DC.
You go for the DC.
Yeah.
Therefore, it means that you are a very good risk taker, because any risk taker will go for the DC. Because here we say the risk and the liability comes to you. If the scheme performs very well, the fund manager is investing very well in the market, then you will get high benefits. But in a DB scheme, like my good friend Florence is saying, a DB scheme, what you will get, you just know it. You just know it. Therefore, it's none of the business. Whatever the scheme is doing is none of your business. Whatever the scheme is doing is none of your business. Now, remember, when we are accounting for this, we are going to account it on the perspective of the employer. On the perspective of the employer. How the employer is going to recognize this scheme in the financial statement. I believe you are getting. We are going to see how the employer is going to recognize these expenses in the financial statement. Now, when we go to a DC scheme, we have said that the employer has no liability there. Therefore, when the employer contributes money, the best example, listen very well, the best example of a DC scheme is NSSF. NSSF is a DC scheme. Whatever you are taking to NSSF is fixed, but what you will get in future, it's not known. Therefore, the best example is the NSSF contributions. NSSF is a DC scheme. Is a defined contribution scheme. Therefore, in a DC scheme, like what the employer is doing for NSSF, now come home and see the NSSF, what the employer is doing for NSSF, the employer will have to debit P&L as an expense, the same way you pay salaries, that is a DC scheme, and you credit cash. You credit cash. That is the work of the employer. Therefore, the employer has no liability. Listen very carefully. The employer has no liability there, because the moment at every month the employer pays your pension, he debit the P&L as an expense, you credit cash, then he's done with his work. Waziri, lab fund and CPF sinanguka wapi? I will explain that. Let's first understand this one. Now, in a defined contribution, that is the DC scheme, what we are saying is that the employer will have to debit P&L, then you credit cash. You credit cash. That is, the employer has done his work. But when we come to defined benefit, remember, in a defined benefit, the employer has promised you, in a defined benefit, that we are in 2020, the employer has promised you that in 2060, I will pay you 10 million in 2060. Listen very carefully so that you understand this concept that we are putting across. Therefore, you are in 2020, but the employer is promising you, my good friend Waziri, that I will pay you 10 million in 2060 when you retire. Therefore, the employer, once he promises this money, then he has the liability. He has the liability. Therefore, this liability needs to be recognized in the financial statement in year 2020. Because once I promise you, it becomes a liability. This liability will be recognized in the financial statement, from year 2020. But the question is, am I going to recognize 10 million in 2020? Definitely no. This is future money. This is future money. I have promised you 10 million in 40 years to come. That is future money. Therefore, what we do to recognize in year 2020, I'm going to discount it to present value. I'm going to discount that 10 million to present value. For example, when I discount it, I get 1.5 million. When I discount it, I get 1.5 million. Therefore, this liability to the employer in 2020 is 1.5 million. 1.5 million. Now, each year you give service, each year you give service, each year you give service, this money is growing, Each year you give service, the money is growing, the money is growing, the money is growing, and then it will come to 10 million. Therefore, the liability will be increasing gradually. The liability will be increasing gradually, and then it comes to 10 million. Therefore, this liability, listen very carefully so that you don't miss a point. This is the point you need to listen so that you understand the concept. This liability that we have in year 2020, we call it defined benefit, liability or obligation, liability or obligation to the company. Remember, the company has this obligation. For example, if you are going to retire today, this is the available benefit for you. This is the available benefit, therefore we call it defined benefit, liability, or defined benefit obligation. The liability that we have discounted this amount that we shall pay in future with the present value is called this. Now, each year you give a service. This money will grow. Like when we come to year 2021, it has come to 1,600. When we come to year 2022, it has come to 1,800, for example. When it comes to year 2025, it has come to maybe 2.2 million. It is growing gradually. Therefore, this increase in the obligation, we are going to call it current service cost. Number one, current service cost. Listen very carefully. That increase in the defined benefit obligation or liability, we call it current service cost. Now, examiner might want you to define what is a current service cost. Current service cost can be defined in two ways. Listen very carefully. When you go to our notes, all those things are there in our handout, but because you are in class, let me explain. Current service cost can be explained in two ways. Number one, it is the increase in defined benefit obligation due to services rendered by employees in the current year. The increase in defined benefit obligation due to the services rendered by the employees in the current year. Or we can define it in a different version that these are the payables to the employees, for the services rendered in the current year. Payables to the employees for the services rendered in the current year. We call it current service cost. Now, this current service cost, it is an expense to the employer. Therefore, you are going to debit P&L, then you credit defined benefit obligation, DPO. You credit defined benefit obligation, DPO, because remember it's an expense that you are not paying. I believe my good friend Waziri, you are listening very carefully. It's an expense that you are not paying, but it is increasing the liability. It is increasing the defined benefit obligation or liability, because each year you keep service, the liability is increasing from 1.5 to 1.6 as you keep service. As you keep service, it is increasing. Therefore, that increase, we are calling it the current service cost, or the benefit you need to get and part of pension. Then, also this money, listen very carefully, this money, it's a liability. It is a liability. This money, 1.5 present value, is a liability. But are we paying it today? No, we are not paying it today. It is growing until it comes to 10 million in 2060. Therefore, the company has a liability. This liability, this expense that is coming out of this liability, we call it the interest cost. Interest cost. Interest cost, remember, this liability we have, when you have a liability in the company and you are not paying it today, then it will attract interest at the market rate. It will attract interest at the market rate. Therefore, that interest is what we are saying there. It is also an expense to the company. That interest is an expense to the company. Therefore, you are going to debit P and L. With that expense, you credit a DPO. DPO, defined benefit obligation. You are going to debit P and L. That expense, you credit defined benefit obligation. Defined benefit obligation there. Defined benefit obligation. Then listen very carefully. Now, this is the scheme. This is the scheme we started in year 2020. Now, for example, when we started this scheme, we promised you 10 million. I promised you 10 million because the company was not doing well. Then I gave you very minimum amount of pension, only 10 million, because the company was maybe just a startup company. It was not doing well. But it comes out sometime, the company becomes a very cheap company, very good company. Performing is very awesome. Like now, Safaricom. When Safaricom started, it was only having 200 employees. Today, Safaricom is having over 10,000 employees because it's doing very well. Doing very well. In fact, if you work with Safaricom, everybody will have to respect you because he knows that you work for a cheap company, a very good company. Therefore, now the company can come a time, maybe we started in year 2020, when we are in year 2030, then they consider to improve your pension. They consider to improve your pension. They say, this person is doing a very good work and I need to improve the pension. And when we want to improve, we backdate the improvement. We backdate the years you have already given service. We want also to improve, to increase that benefits. Therefore, that benefits we are paying you for the already done work here, we call it past service cost. Past service cost. We are going to compensate you for the work already done. We call it past service cost. Therefore, this is also an expense to the company, but it is going to increase the liability because we are not paying it today. We shall pay in year 2060. Therefore, it's a liability, it's an expense, but the expense is going to increase the liability. Therefore, you debit P and L, you credit DPO as an expense there. You credit DPO as an expense. Therefore, these are some of the expenses that will arise to increase the obligation. As you see, we are crediting the obligation. To credit obligation means we are increasing that obligation or liability. Defined benefit, liability. Liability is what the employer will pay in 2060. what the employer will pay in 2060. Therefore, those are the items that the employer is going to recognize in the financial statement as expenses. Remember, the employer will first recognize this as a liability in the balance sheet. Then we have the expenses, current service cost, interest cost, then past service cost. Are we together there? Yes, of course we are together. Now listen. Let me pause. Now listen. For the employer to pay this liability, the employer will require what we call planned assets. For the employer to pay the liability, he will require what we call planned assets. What are the planned assets? Planned assets are the contributions the employer is taking to the scheme. I already said the scheme. The contributions the employer is taking to the scheme is what is making up the scheme assets. Because I have the liability and I need to pay this liability, the employer is taking money to the scheme, to pay this liability. Therefore, here, planned asset will include contributions. Contributions that the employer is taking to the scheme. The contribution the employer is taking to the scheme, how will we account for this contribution? Who can tell us? Here, we are going to debit planned assets because we are increasing the planned assets to come and pay the liability. Then we credit cash because here we are contributing cash to the scheme to be invested. We are contributing money to the scheme to be invested. Therefore, the employer will debit planned assets, you credit cash in your books. Then, when this money goes to the scheme, they will be invested in the market. I already said the real estate, the corporate bonds, equity investments. We are going to invest that money. When we invest, we expect returns. What are the returns are we expecting? We have what we call expected returns on investment. This expected returns on investment will be increasing the planned asset. Therefore, we are going to debit planned assets. Because it's increasing the planned asset, we credit P and L. It's an income to the company. We credit P and L. The company is getting something from the investment. Therefore, we are debiting planned asset to increase the planned asset. We credit P and L. That is how we are going to account. Now, I said, remember, in a DC scheme, listen very carefully because you need to understand what Mwalimu is saying here. In a DC scheme, if we have a defined contribution, when we do the contributions, what did I say? You are going to debit P and L. In a DC scheme, you credit cash. That is the end. But when we come to DB scheme, the contributions is not an expense. It is forming part of assets. We debit planned asset. We credit cash. We debit planned asset. We credit cash because making up the assets to come and offset the liability. But I said in a DC scheme, the employer has no liability. Therefore, the moment you pay the money, you contribute money to the scheme, you debit P and L, just like when you debit salaries, you debit rent, you debit any expense, you credit cash, you are done. But in a DP scheme, it is different because it is going to form part of the assets that will offset the liability. It's forming part of the asset that will form the liability. Now, listen very carefully. Here we have the assets. At the same time, we have the obligation. Like here, I say this obligation is growing. Then let me say we are here. The obligation is 2 million like this. 2 2.2 million. Then we expect that the assets in the scheme also should be 2.2 million, because the assets needs to offset the liability at any given time. Any point in time, this liability, these assets need to offset the liability. But you will find that in many instances, these things are not concurrent. They are not on the same level. At any time, they are not on the same level. You find that maybe the assets, what the employer has contributed is only 1 million, because we say what the employer contributes to the scheme is not fixed. That one we agreed. What you contribute to the scheme is not fixed, but what we pay is fixed, is not. There you find that the liability is 2.2, but the assets is only 1 million. Therefore, these assets cannot offset the liability. If this employee retire, it cannot offset. Therefore, listen very carefully now what I'm going to say. The actuary will be coming each year, the actuary will be coming each year to evaluate the plan assets and also evaluate the plan liabilities, so that he makes sure that the plan assets and plan liabilities can offset, to advise the company. If, for example, here, if in this case, the assets are 1 million, the liabilities are 2.2 million, then the actuary will advise the employer that in this case, you are required to contribute more. In this case, you are required to contribute more. Therefore, we are going to value the scheme based on the actuary. We are going to value the scheme, valuation of the scheme. We are going to value the scheme and see how the employer is going to recognize these items. So you say, I have a question, Waziri, just ask a question, or you want me to unmute you, Waziri? Therefore, you can unmute and say, ask if you so wish.
I just wanted to ask a question on that point before you proceed. You
Yes.
said, for example, by 2030,
Yes.
the employee wants to quit, and then the assets, you gave an example, are just 1 million, and the liability is 2.2 million. But then I was thinking, and there may be the repercussions of termination of the contract, because the employer knows that this person is retiring by 2020, unless now maybe it is just other issues, like you transfer from one entity, for instance, in government to another, or maybe level from the county to national. But if today I decide I am retiring at 30, early retirement, I think there is that window, because otherwise the employees will always have to look for money. That was my question.
It is a very good question. Remember very well, the scheme is not only for one person. The scheme is not only for one person. That is just an example. The scheme is not only one person. The scheme has, like, for example, if you are working for the ministry, you will find that in that ministry, we have like 3,000 employees, and all these employees are members of the scheme, all 3,000. Therefore, you will find that, for example, you alone, Waziri, you alone, maybe you are required to be paid 2 million, but the, or for example, let me say Bolsa, you will find that the scheme has the liability of 200 billion, let me use the word million. 200 million, that's the liability, but you find that the assets are only 150 million. Therefore, if you alone, Waziri, you alone, you want to go, maybe you have, let me say you have 1.5 million. The scheme will just pay you. But in this case, we are saying, for example, if the scheme wants to wind up, remember, it needs to compensate all these employees. If the scheme wants to wind up, it needs to compensate all these employees. Therefore, these assets are not able to pay 200 million. That is why I was saying, in a scheme like a DP scheme, we need somebody called an actuary. An actuary. An actuary is the person who will be valuing the scheme assets and also value scheme liabilities, so that he advises on the employer that in this case, the employer needs to take more money to the scheme. The employer needs to take more money to the scheme. But when it comes to individual level, like for example, if you want to move from county government to national government or national government to county government, you alone, maybe you only need 1.5 out of 150 million. We will pay you. The scheme will transfer your money. But now it comes out that, for example, we have what we call settlement and curtailment. We are going to discuss them. Settlement and curtailment. We are going to discuss them wholesome. When the scheme wants to close up, like many companies close, like NAPMAT, for example, maybe you are working with NAPMAT, it closed doors. Maybe you are working with Taskis, it closed doors. Therefore, in that case, if, for example, Taskis is closing the doors and it has been using the DB scheme, defined benefit, you find that they will not be able to pay the employees their benefit because the assets are less. That's why I was saying there need to be somebody called an actuary. That is where we are going now to value the scheme assets and the scheme liabilities, to show you how the actuary will be coming to value the scheme assets and also value the scheme liabilities and advise the employer that in this case, unless you increase on your contribution in Nikubaya, unless you increase the contribution here, Nikubaya. Therefore, let's say preparation of financial statements. You say preparation of financial statements, preparation. You say preparation of financial statements under defined benefits, scheme, DP scheme. Preparation of financial statements under defined benefit scheme, preparation of financial statements under DP scheme. Now, the following are the steps, the following are the steps to be followed when determining the amounts to be recognized in the financial statement. The following are the steps to be followed when determining the amounts to be recognized in the financial statement by the employer. You can even put the word by the employer. Step number one. We have what we call determination of actuarial gain or loss on plan liabilities and plan assets. Determination of actuarial gains or losses on plan liabilities and plan assets. Let's begin with number A. Actuarial gain or loss on plan liability. Actuarial gain or loss on plan liability. Let me assume we are in year 2024. Actuarial gain or loss on plan liability. Now here, a person called an actuary is a person who values risks. When you go to insurance companies, we have a person called an actuary. This person is work. If, for example, you have an accident, he will come and evaluate the damage, the level of the damage, and recommends either to be compensated or not, because it's a person who values risks. Therefore, he will come and value here. Now he's coming to value our plan liability. And when the actuary is coming, my good friend Waziri, listen, when the actuary is coming to value the scheme, he will be using what we call actuarial assumptions. Actuarial assumptions. What are the examples of actuarial assumptions? Examples of actuarial assumptions is the employee turnover, employee turnover in the company, Number two, the interest rate in the market, the interest rate in the market. Number three, the level of contribution by the employer, Those are some of the increase in salaries, increase in salaries by the employer, increase in salary. Those are some of the examples of actuarial assumptions the actuary will be using to value the plan assets and the plan what? Liabilities. Now, the actuary will take what we call present value of plan liability at start of the year. He will come at the start of the year to check what are the liabilities in the company. You find that, for example, the liabilities are 2 billion. Those are the liabilities. Then he comes and evaluates what are the actuarial assumptions. What are the things that will make these actual liabilities increase? Now we come to number one, we said current service cost. He will add current service cost. He will add current service cost. We said these are the payables to the employees. He takes current service cost, he adds there. Then he also come and see if there is any past service cost, He comes and see if there is any past service cost. Then he takes the interest in the market, interest expense. What are those things, mwalimu? Network kidogo misbehave na employee turnover etc. I'm saying that these are the actuarial assumptions, the things that the actuary will be using to evaluate the liabilities and the assets. We call them actuarial assumptions when we come to this employee turnover, interest rate in the market, level of contribution by the employer, then increase in salaries. For example, salaries may increase during the year. Those are the things we call actuarial what? Assumptions. Now, what is the essence? Listen very carefully. What is the essence of all this liability? The essence of this liability is to pay out benefit, is the benefit of other people. Mwalimu, give me an example of current service cost. Now, current service cost, when we come to evaluation of this scheme, for example, each year you are giving service. Listen very carefully, Florence. Each year you are giving service, you are qualifying a certain payment. You are qualifying for a certain payment in the pension. Each year you give a service under BP scheme. Each year you give a service, you are qualifying for your benefits. You are qualifying for your benefits based on actuarial valuation. Based on actuarial valuation, you are qualifying for a benefit. Like, for example, we said you will retire in 2060, you get 10 million. Therefore, this 10 million, we are going to discount it to be 1.5. Now, 1.5 will be increasing gradually. Each year you give service towards 10 million. Each year you give service. When you come at this point, we now evaluate. When we discount this amount, how much is it now? In the year 2023, And in year 2023, you find that it's 1.6. Now that increase, it means the employee has earned something. When we come to year 2024, when we evaluate this amount, you find that it has come to 1 point, or it has come to 2.0. Therefore, it has increased as you are giving service. Therefore, that increase is what we are saying current service cost. That increase is what we are saying current service cost. And it has to increase. Yes, this must increase because each year you are giving service, if the benefits are, you are entitled to benefits, you are entitled to benefit. Therefore, that benefit you are entitled to each year, you give service under defined benefit, is what we are saying current service cost. To the employer is a current service cost, but to the employee is a benefit. We said these are the payables to the employees for the services rendered. Therefore, you need to get something. Now, I was saying that the essence of these liabilities, these are the benefits of employees that they need to be paid. Therefore, if any employee is paid, then we reduce the obligation, less benefits paid. The reason why we are subtracting benefits paid here is that each year you give us service, each year you give us, you retire. For example, I say the scheme has like 200 employees. Some are retiring this year, some will retire next year, some are joining. Some are joining, some are retiring. Some are joining, some are retiring. Therefore, those who are retiring, like in the company you work, I believe last year people retired. Therefore, when you retire, you are paid your benefits. Therefore, when we pay benefits, we reduce on the obligation. Because it was 2,000 obligation, we are paying 200 million to people. Therefore, it remains 1,800 as obligation. Now, the actuary will be using these actuarial assumptions. Then we get what we call projected book value. Now, the actuary will come at the beginning of the year. The actuary will come at the beginning of the year to evaluate all this. Then he gives us at the beginning of the year. Remember, I'm using the word at the beginning of the year. He gives us the projected. For example, the projected here is 2,500. And you are projecting, putting in mind the actuarial what? Assumptions. They are just an assumption. It might change from what you expected. Like, for example, at the beginning of the year, you are expecting that the interest rate in the market will be 10%. But during the year, it increases to 12% or 15%. That's why we are saying actuarial assumptions. Then employee turnover. Maybe you are expecting that you will remain 200 employees in the company, but you find that 6 employees or 10 employees gets out of the company, left the company, then we only remain with 190 employees. When the employees are going, then the obligation is reducing. Therefore, that's why we are saying actuarial assumption. Now the actuary will come and project and gives us the liability. Then it comes out that whatever he projected is not actual at the end of the year. Therefore, you skip one line and say, present value. You skip one line and say present value of planned assets, planned liabilities at the end of the year. It comes out that what we projected is not actual. What we projected is not what is actual. Whatever we projected 2,500, but actual comes to maybe 3 million. Actual comes to maybe 3 million. Therefore, the difference between the projected and the actual, is what we are calling, we call it actuarial gain or loss. We call it actuarial gain or loss, the difference between the actual and the exact amount, we call it actual gain or loss. That is on obligation. Now they actually has come to value. Now let me ask you here. For example, I projected 2,500. At the end of the year, it's coming to 3 million. I projected the ability to be 2,500, and at the end, the exact obligation is coming to 3 million. We have a difference of 500. Is it a loss or a gain? This one is for Ruth. This one is for our good friend Ruth. I projected 2,500 as liability, but at the end, we are getting 3 million as liabilities, exact. Now, the projection, actual gain or loss, is it a gain or a loss? Or anyone can help Ruth? It's a gain. This one is not a gain. This is a loss. This one is a loss because increase in liabilities is a loss. Increase in liabilities is a loss. Increase in liabilities is a loss. Now, let me come to the second item. Second item, number B. Number B is actual gain or loss. Actual gain or loss on plan assets. 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 Here we are still in year 2024. I'm going to take my fair value of plan assets at start. Fair value of plan assets at start of the year. I want also to value the assets and see if the assets should offset the liabilities. Then what will increase the assets in the company? What will increase the assets in the company? The contributions by the employer. Contributions by the employer will increase the assets. What else will increase the assets? Return on investment, the expected return. Thank you very much, Ruth. Expected return on investment. Expected return will increase the asset. And why am I accumulating all these assets? Why am I doing all these assets? Is to pay out benefits. Therefore, if I pay out benefits, like here I paid out benefits, then I will reduce the assets because this is money I'm paying to people. There will come and less benefits paid. We come to less benefits paid. We come to less benefits paid, then we get what we call projected book value. Projected book value. Projected book value. This is as per the actuary at the beginning of the year. Listen to the word beginning of the year. The actuary is coming to value the scheme so that, for example, here, our liability at the beginning of the year, it was 2,500. When we come to the asset at the beginning of the year, it's coming to 1,500. Therefore, the assets cannot offset the liabilities. Therefore, here, the actuary will have to advise the employer. Will have to advise the employer to increase on either contributions because they need to offset. Then it comes out that now skip one line and say fair value. You skip one line and say fair value of plan assets at the end of the year. At the end of the year, now this is the exact amount we have. Fair value of the plan assets, that is what we have as an exact. Given all the variables that we put in, that is what we have. The difference between what we projected is called the actuarial gain or loss. Actual gain or loss. The difference between the projection and the actual, we call it actual gain or loss. Actual gain or loss. Actual gain or loss. Now, for example, we projected 1,500. It comes out that it's 2,000. The assets are 2,000. That is a gain because assets are increasing. Whenever assets increase in the company, it's a gain. Whenever assets reduce in the company, it's a loss. Therefore, this one is a gain. Because I projected 1,500, but at the end, what now the book value is showing? The book value is showing 1,500, 2,000. Therefore, the assets from the projection has increased. We call it the actuarial gain. Now you put a dash and say, you put or NB, or a note, and say actuarial gain or loss are recognized directly as other comprehensive incomes. Actual gains or losses are recognized directly as other comprehensive income. Therefore, these actual gains that are arising in this scheme, the company needs to recognize it directly in its financial statement as other comprehensive income, that is OCI. We call it OCI in abbreviation, OCI, other comprehensive incomes. We recognize it directly as OCI, other comprehensive what? Incomes. That is step number one, determination of actual gain or loss on planned assets and planned what? Liabilities. That is step number one. We go to step number two. Step number two will be a determination. Step number two is determination of the amounts to be recognized in profit or loss as pension cost or pension expense. Step number two, determination of amounts to be recognized in P&L, that is profit and loss, as pension cost or expense. Determination of amounts to be recognized in P&L as pension cost, or here, let me assume we are in year 2024. I will take current service cost. We are accumulating the expenses that has arose in the company. What we are doing, we are just accumulating so that we report as one figure. Therefore, I will take current service cost, past service cost, then interest cost, I come to less expected return on planned asset be less. Then I also add loss on curtailment. Loss on curtailment, I will explain what is curtailment. Then I also add loss on settlement. Loss on settlement. Then I get what we call pension cost or expense. This is the amount I'm taking to P&L as expense. That is the amount I'm going to take to P&L as expense, This is the amount I'm going to take to P&L as expense, That is step number 2. You determine the amounts the company is going to recognize in the P&L. Like, for example, when you see some financial statement, you will see something like pension expense. This is what we are talking about, pension expense or pension cost. In some financial statements for published, for example, you have done intermediate, AFR intermediate, you will find we have these things there. Therefore, this is what we do. Now I'm showing you in how you do them. Then our last step is amounts to be recognized in the balance sheet. Our last step, number 3, amounts to be recognized in the balance sheet as pension liability. Amounts to be recognized in the balance sheet as pension liability. Let me assume still we are in year 2024. Here, I'm going to take present value of plan liability at the end of the year. At the end of the year, the liability that I have, I come to less fair value of plan assets at the end of the year. I less fair value of plan asset at the end of the year. I less fair value of plan assets at the end of the year. Then the difference is what I'm calling pension liability. Pension liability. That difference is, therefore, remember you have the liabilities at the end of the year. Also, you have the assets at the end of the year. Therefore, if the assets are less, for example, here, the liability is 2,000. Assets is 1,500 in the scheme. Therefore, it means you have more liabilities of 500. That's what you are going to recognize in the balance sheet as pension liability. But I know my good friend Waziri will ask me, suppose the assets are more. For example, here, the assets are 2,000, the liabilities are 2,000, the assets are 22. Therefore, the assets are more. Therefore, I have 200, but planned assets. I have 200, but planned assets there. If at the end of the year in the scheme, assets are more than the liabilities at the end of the year, we have what we call planned assets. We recognize in the financial statement as planned assets. But if the liabilities are more, like in the first case, 2,000 versus 1.5, then we have what we call planned liabilities. We have what we call planned liabilities. I believe you have seen those steps that we are going to follow to recognize this defined benefit scheme in our financial statement. Now, before we go even far, if this is a planned asset, listen carefully. If in the scheme it comes out that if liability is more, it is planned liability. If liability is more, it's planned liability. That is good progress. If liability is more, it is planned liability. Or pension liability or planned liability, it is the same. When we say pension liability, like here we said pension cost, it is just the same pension cost or pension liability or pension plan liability or scheme liability. It is just the same thing there. Now let me explain something which is very critical. This one you need to listen very carefully. Very critical. Now, if it comes out that the assets are more than the liabilities, if it comes out that the assets are more than the liabilities, then it means that what the employer has taken to the scheme is more. If If the assets are more than the liabilities at the end of the year, then it means that what the employer has taken to the scheme is more. Therefore, which effect is it going to have on the scheme? Which effect is it going to have on the scheme? It means this: if the assets are more than the liabilities, then in future, the employer will not contribute. If the assets are more than liabilities, then it means that in future, the employer will not contribute, because already you have more in the scheme than the liabilities. Or if the assets are more in the scheme than the liabilities, then if the scheme is winding up, then the employer will be refunded the money. Listen very carefully before I unmute you, Florence. If the assets are more in the scheme, like for example, we have more assets, then we are winding up the scheme, then it means that the employer will be refunded. Therefore, this planned assets, we call it planned surplus, has two effects. Number one, the employer can be refunded his money. Number two, the employer can reduce on the contribution because he has more assets. Now, let me unmute my good friend, Florence. What if assets are more due to return on assets? When will employer do? What will employer do? Then that is what we are saying. If the assets are more, then because remember, this scheme is under the employer. Therefore, if the assets are more due to the return, that is a gift. Let me use the word gift to the employer. It's a gift to the employer. He will get back those returns. Or if the scheme is continuing, he will reduce on contribution because the scheme is doing very well. Therefore, the contributions will reduce. But if the scheme is winding up and the assets are more, then the employer will be refunded. Let me unmute my good friend Florence. Florence, unmute.
Mwalimu, thank you. So I've understood your point.
Yes.
Please explain to me what this liability means to an employee.
What?
The liability, what does it mean to an employee? Because you see, the contribution is an asset.
Yes.
How about this liability?
Now, the liability, remember, the moment you got that employment, Florence, for example, umepata kazi 2020. And in 2020, because the employer is using what we call PP, defined benefit, he's promising you that when you retire, I will pay you 10 million, for example. Therefore, this 10 million the employer is promising, that is a promise, is what is becoming the liability to the employer. That is why we said that this is future money. Therefore, we discount it to the present value and see how much is 10 million in 2020. How much is 10 million? Therefore, this is what we are calling the liability. The employer already has the liability because of the promise. Just saying that first, there is a formula. I will remember maybe tomorrow and give you that formula. Therefore, we use the formula to calculate based on your number of years, based on your salary. Therefore, based on those variables, we get how much will you get. Therefore, then, as we calculate that amount, then the employer says, oh, I need to pay 10 million. Then he asks the actuary, a person called actuary. Now, how much is 10 million today? How much is 10 million today? Then actuary says it is 1.5. Then the employer, this becomes now the liability to the employer. It's a liability. The employer has obligation that if the employer goes today, the employee goes today, I need to pay 1.5. 1.5 that is coming from this promise. Remember, this is just a promise that if you will be in the company in 2060, this will be your pension. Your pension. Therefore, I have already promised you that amount. Therefore, that is what is becoming a liability, Florence. Any other question, Florence? Any other question, Florence? Thank you very much. Thank you very much. You say no. Thank you very much. Thank you very much. Thank you very much. Thank you very much. Now, listen very carefully. Now, I said that if these assets are more than the liabilities, then the employer will either be refunded or it will reduce on the contribution in future. Therefore, here, according to IAS 19, this asset is required to be measured at what we call asset ceiling. Asset ceiling. It is required, this asset is required to be measured at what we call asset ceiling. What is asset ceiling? This is the amount, this is the amount that is lower of number A. Asset ceiling. What is asset ceiling? This is the amount that is lower of number A, exact amount as calculated, the exact amount as calculated in the scheme. Exact amount as calculated in the scheme, like here we have calculated, for example, it's 200. Then number B is the lower of number A, exact amount as calculated in the scheme. Number B, the present value of future economic benefits that will be available for refunds, economic benefits that will be available for refunds or reduction in the future contributions. The present value of future economic benefits that will be available for refunds or reduction in the future contribution. Then we are going to measure it at the lower. For example, here we have calculated 200 million, but when we check on the economic value, present value of the economic future refunds, maybe it comes to 150. The refunds is only 150. The refund is only 150. Therefore, if I want to report this in my financial statement, I will not report 200. I will compare. The refunds need to be 150. But what I have calculated is 200. I take the lower. Which one is lower? 150. Therefore, in my financial statement as an employer, I will not recognize what I have calculated, but what I will get as a refund or what will reduce my contribution in the future. Therefore, that's what we are calling asset ceiling. This is the amount that is lower of. Therefore, this amount will be measured at the lower of. When you go to our notes, you will read these things kindly. You go to our notes and read and understand what is the asset ceiling. When you go to our notes, I prepared very good notes there under employee benefits. We have asset ceiling there. You go and check and understand all those points Therefore, that is what you need to understand in a DB scheme, how the employer will be recognizing all those halbalu, how the employer will be recognizing all those halbalu. Now, let's pick one question and see what we can do there. Let's pick one question and see what we can do there. And the question is November 2020, question number 5B. November 2020, question number 5B. November 2020, question number 5B. Let's go to November 2020, question number 5B, and see what the examiner wanted there. November 2020, question number 5B. Quickly, when you are there, you say yes. I say that you need to have those handouts. When you are there, kindly notify Mwalimu by saying yes, so that we move together. Thank you very much, Ruth. You are there. Thank you very much. Thank you very much, Ruth. You can represent everybody there now. I believe everybody is there. Now, this question says like this, November 2020, it says like this. On 1st January 2019, Community Limited commenced a defined benefit pension plan for its employees. Under the pension plan, Community Limited has an obligation to provide staff with agreed post-employment benefits. Community Limited carries the actuarial and investment risk associated with the pension scheme. The following information has been combined for the financial year ended at 1st December 2019. We have interest income on plan asset, employer contribution to plan, current service cost, interest on plan liability, fair value of plan assets that 1st December 2019, present value of plan obligation that 1st December 2019. Community Limited's accountant was not sure which accounting standard to apply when accounting for the pension scheme. The only adjustment made to the account for the scheme was to expense the company's contribution of 55 million for the financial year ended at 1st December 2019 in the statement of profit or loss and other comprehensive income, and to credit the cash account required. Evaluate the treatment Community Limited's accountant has given the above issue and offer the correction if and where necessary. Use journal entries, 10 marks. Where necessary, use journal entries, 10 marks. Now, what I'm going to do in this question, I'm giving you the journal entries, but this other financial statement, you are going to prepare the steps as we agreed. As I have shown you, you are going to prepare the steps. But for me, I'm showing you the journal entries. Examiner wants us to account for this question. Then he is saying that on 1st January 2019, Community Limited commenced a defined benefit pension plan for the employees. Under the pension plan, Community Limited has an obligation to provide staff with agreed post-employment benefits. Community Limited carries the actuarial and investment risk associated with the pension scheme. The following information has been compiled for the financial year ended at 1st December 2019. We have interest income on plan asset, employer contribution on plan, current service cost, interest on plan liability, fair value of plan asset, all those examiner has given us. Community Limited's accountant was not sure which accounting standard to apply. This IS 19, of course, is the standard we are going to apply. The only adjustment made to account for the scheme was to expense the company's contribution. Now remember, under DB scheme, you are not required to expense the contribution. I already explained that. Under DB scheme, you are not required to debit P&L with the contribution, credit cash. You are not required to do this. This is wrong under DB scheme. Under DB scheme, when you do the contribution, you are going to debit a plan asset with 550. Then you credit cash. I'm giving you journal entries in this question. You credit cash with 550. That is what you are required to do. But what this accountant did, he debited P&L and credited cash. This was wrong. Therefore, examiner wanted to show you to show those journal entries. Then that is journal entry number 1 on contribution. What about journal entry number 2, current service cost? Current service cost. If I have current service cost, what is my journal entry? Current service cost, we said you debit P&L with 600,000, you credit DBO, defined benefit obligation with 600. That's a journal entry. Examiner said, whichever any case you can use journal entries. Now we are correcting. Number 3 journal entry here. When we have interest expense, how do we journalize that? How do we recognize that? Interest expense, how do we recognize that? Remember, this person made a mistake on contribution. Instead of debiting planned asset, he debited cash. When you read question and understand. This one you are going to debit P&L with 18. Then you credit DBO. DBO is defined benefit obligation. Defined benefit obligation or liability. DBO is defined benefit obligation or liability. Then journal entry number 4. Journal entry number 4, interest income. Interest income. What do we do with interest income? What will be our journal entry on interest income? On interest income, you are going to debit. You are going to debit planned assets. That's expected return. In short, expected return. You debit planned assets with 16,500. Then you credit P&L. It's an income P&L 16,500. 16,500. That is what you do on as part of journal entry to correct. But what examiner wanted mostly is to correct the contribution. You debit this account, you credit that account. Therefore, because of time, I see we only have 10 minutes. I cannot do the whole sum of this question. Therefore, I believe if tomorrow, God willing, we shall meet at 5 p.m., then we shall finish with the steps. But you can do it. You can do it because Mwalimu has already shown you how to prepare those actual gains, pension cost, and pension liability. Mwalimu has already shown you. Therefore, you can do it. Then after you have done this, you also do for me. Now you are doing for Mwalimu, but on 2nd of April, you will be doing for yourself. But today, you are doing for Mwalimu. Today, you are doing for me. You can also do the question of May 2019. I believe question number 3, B or A. Then also you do for me April 2022. I think question number 2 or 3 there. April 2022. Then you also do for me the question of December 2017, question number 2C. December 2017, question number 2C. Those are the questions I want you to attempt. Also, this one, you finish it, then you do all those. Tomorrow we meet, we shall go through them. We finish, then we go to the next topic. It will be the end of this topic. Therefore, that is good. And I just wish you well. Because of time, we are only remaining with less than 10 minutes. I cannot rush doing it because you need on one hand to understand. On the other hand, also, we need to finish the syllabus. Therefore, the most important thing is you need to understand. Therefore, I don't want us to rush so that we complete the question, but nothing you are getting. Thank you for your time today. I believe all shall be well. We meet tomorrow at 5 p.m. But I will communicate before 1. Tomorrow before 1, I will communicate the progress. I will communicate the progress tomorrow before 1. Thank you very much. Have a good evening.